Alrighty, guys. Well, welcome to another Office Hours with Anthem Capital. I've got some special guests here today that I'm going to let introduce themselves. We started back in 2022 and we're in 2023 now. We are sorry we missed the April one, but as many of you know, we had a deal going on. And one of the big leaders and advocates in this deal were these two lawyers that I have available with me today, talking about opportunity zones. So with that, I'm going to go and mute myself so you guys don't listen to my baby and dog make noise. But I'd love to introduce you guys to Stephen Slawinski and Patrick Sughroue. They are experts in their field, and they have been phenomenal in helping us structure our deals for opportunity zones and beyond in real estate. So guys, please take it away.
Thanks, Dan. I'll start, Stephen, if that's okay. And thanks for the opportunity to participate in the lunch hour series here. My name is Patrick Sughroue. I am a business financial transactional attorney and have been one for some time. I am out of West Michigan, Grand Rapids, Michigan, but my practice is national. I do and have done pretty much exclusively deal structuring, alternative investments, alternative assets, deal structuring, a lot of tax incentive type stuff my entire career. And so when the advent of the 2017 Tax Act occurred, I took a deep dive into what is this thing called opportunity zones and opportunity zone investing. And I can tell you this, I dove and I'm still underwater and I'm still with the rest of the industry and trying to sort of manage it all, figure it all out and see what best practices are. And so in doing that, I like to affiliate with and get to know some of the experts in the field and related fields that relate to this space, like in real estate syndications. And that's how I met my colleague, Stephen Slawinski, and we worked together on structuring real estate and opportunity zone syndications. Stephen, why don't I turn it over to you for an intro?
Yeah, I appreciate it. So my name is Stephen Slawinski. I focus mainly on securities law. Also, I'm located in Phoenix, but also have a national practice. I've pretty much focused on real estate securities my entire career. One of the things that I've been able to do though is partnering with guys like Patrick to develop just really unique deal structures that can really provide some excellent opportunities and excellent solutions to clients. It's one of my favorite parts of this. But another thing that I've been really focusing on is developing the systems and processes around these creative deal structures in order to provide efficiencies to clients. When deals are needed to close in 30 days, maybe 30 to 90 days. We need good documents that can withstand the test of time, withstand scrutiny, but also be done efficiently. And so that's what I provide. And of course, under the guidance of expert attorneys like Patrick, we've been able to do that over at my firm. So that's about me. I'm still learning about opportunity zones. I'm really here as far as opportunity zones, the compliance aspects. I'm still learning under Patrick. So, but as far as deal structuring, I'm always happy to discuss any questions people have about that.
And Stephen, let's not forget that you also have twins that are
Oh
2 weeks old.
yeah. Well,
That's
it's
also
funny
something you
because
got going on.
you have a newborn and I see you drinking this healthy green smoothie. I'm over here drinking energy drinks just to get through the day. So some of us are making good choices.
Well, parenting, especially in numbers, is for the young. So good luck, fellas.
Oh
Even
gosh,
even,
yeah.
even our grandkids are, some of them are up there a little bit.
Yeah, I wouldn't wish this on most people. I love it though, but it is tough. My wife and I were, I mean, she took the brunt of it last night, but yeah, we were up for a good portion of last night and through this morning. So
Sure.
happens. So
Okay.
I'll let you.
Okay.
Take
Why don't we get started here? I'm going to share my screen. Stephen, let me know if I've done that successfully.
Yes, sir. We're good.
Okay. Okay. So there have been a lot of resources available for opportunity zones and opportunity zone investing that have been published by a number of different forums and experts and whatnot. So there's a lot to find out there, and we're going to provide a list, Dan, to your group of maybe 4 or 5 key resources at the end, and I may supplement this slide if I don't have it in here, to where people can go to get more information. or just handy resources. So this is just a kind of an intro to opportunity zone investing that Stephen and I have put together, which addresses some things way too far in the weeds for what we're going to do unless a question triggers it. But it'll give us sort of a broad overview of what opportunities are, and what sort of is required to do an opportunity zone investment in a compliant manner to deliver really cool tax benefits, and then some perhaps some examples of deal structures and the like that you'll encounter as you look at real estate investment opportunities. So with that, we will proceed. This presentation, as I'm sure all of the educational presentations, Dan, in your realm are, these are just for educational purposes, and they're not professional advice, not tax advice, or not legal advice. So please seek your own counsel as you get into these deals and evaluate them, and make sure your counsel includes your tax preparer and your legal advisor. So opportunity zones were a part of the 2017 Tax Cut and Jobs Act. Subchapter Z of the code was created, and it's about like 5 pages long. It was set up after a study of about, I don't know, 8 years, maybe longer, by various interest groups, including the Economic Innovation Group, EIG, that were looking at the situation of economically distressed communities throughout the country and where they're dispersed. They're kind of all over the place. If you look at this slide, the distressed is trending more towards the burnt orange, and the prosperous are more towards the blue. And the idea of the opportunity zones was to try to deal with this challenge. So there are in the law actually designated which opportunity zones would be opportunity zones, and they did it by U.S. Census tract as viewed through the 2010 census data. And there's like 8,762 opportunity zones in every state. In my state of Michigan, there's opportunity zones in every county. The territorial islands of Puerto Rico, US, VI, and Guam, opportunity zones. As you can see, what they're trying to address is a lower poverty rate and average median income, but also an area, a census tract that has a reason to develop. And so these tracts are developed in every state, and they were nominated by the governors or committees in the states and then ultimately approved by the IRS. When they went into the law, they were fixed. So it literally is going to take an act of Congress to change the opportunity zones from what they were. And that creates a bit of a dilemma, because we have situations where things are dynamic in the economy throughout our country, and various census tracts either improve or maybe digress in terms of their economic status over a series of years. So we already now have a 2020 census that we could take data from. It would be more sort of real in terms of what are the really distressed areas. And there was discussion about amending that in Congress to freshen, if you will, the opportunity zone census tracts. That was rejected by Congress because they felt they had enough to fight about with the 2020 elections. But that concept hasn't been dropped, and a lot of people on Capitol Hill and certainly in the Treasury Department are aware that there are a lot of zones that probably don't deserve to be zones anymore, like downtown San Jose, California, right next to the new headquarters for Google Inc. is an opportunity zone. Obviously, it wouldn't have made the cut if we used the 2020 census data, but those types of things are sort of what I would call imperfections in the legislation and the regs, and you just need to be aware that they exist. Now, that also creates opportunity in that really, I think astute real estate developers and sponsors and project developers and syndicators are going to try to find areas that are in opportunity zones if they're seeking to have an opportunity zone deal, but also have a really good chance of making it sort of without the tax benefits. So it's a good deal in its own right because of where it's at and the team that your developer or product sponsor has sought out, but also it's going to have the advantages of these opportunity zone tax benefits. So again, a couple of things real quick. Opportunity zone program is intended to be market driven. It is not a handout by the IRS. It is not a giveaway. It's intended to drive private investment capital into these designated census tracts to build new projects or new businesses and improve employment through long-term holdings. Again, market-based. There is no limit on how many opportunity zone projects there can be in the United States or in the territories, as long as they comply, and there's no limit to how much capital can be invested. Also, really important, if you're in an opportunity zone, looking at an opportunity zone investment in, for example, a real estate development, all the other tax incentives that you may have featured in some of these programs can still be layered in. Affordable housing, low-income tax credits, new markets tax credits, brownfield tax credits, all that's still there in addition to opportunity zones. And in many cases, they're enhanced because they're in opportunity zones on both a state and federal basis. I'll mention really quickly here that not almost all states, but about 12 of them do not recognize the opportunity zone tax benefits at the state level. So make sure you check with your accountants, like California and New York. North Carolina don't. They all have their own reasons for not, but they are recognized still by citizens of California, residents of California at the federal level, but not at the state level. In New York, the same. So be careful of that. Stakeholders, who cares about opportunity zone? What if I'm not an investor? Who should care about this and know about it? And here's a list of them, and I'll just leave you to take a look at this. It's pretty much everybody in the real estate financial investing sort of spectrum that should care about this, because investors are going to be increasingly wanting to deal with these stakeholders in a way that they understand these tax benefits that could potentially be available. So like everything out of the IRS, the opportunity zone regime has a lot of acronyms. So you're going to hear about QOZ, Qualified Opportunity Zones, QOF, Qualified Opportunity Fund, QOZP, Qualified Opportunity Zone Property, QOZBP, Qualified Opportunity Zone Business Property, and then Qualified Opportunity Zone Business. They each have a very technical definition, so just be aware of that. And sometimes they drop the Q in front of these things, but you'll hear people talk about QOFs and QUISBs and all of that when you get in further into this space. And that's just because it's like everything else in Washington, D.C., it's got to have a bunch of acronyms.
Hey, Patrick, can I just let people know on this? We're going to refer a lot to QOZBs, QOFs. That's how that's kind of how we've structured a lot of our deals as QOFs and QOZBs. And so a lot of the time, just keep that in mind as we talk about deal structuring going forward. We're going to use the term QOF, QOZB a lot.
Absolutely. We have to catch ourselves sometimes with that. Stephen, I think did you just mute yourself? Yeah. Okay,
Yep.
Good. So what are these tax benefits that are available to investors through a opportunity zone investment? There's three major ones. The first one is a temporary deferral of capital gain from the time of investment in a qualifying opportunity zone structured investment until the end of the tax year 2026. A capital gain that was generated from an unrelated transaction. Unrelated means you can't sell to yourself, or your wholly owned LLC can't sell to you, or your wife can't sell to you. It's got to be an unrelated transaction, unrelated parties, that generates a capital gain, and that capital gain you seek to not pay taxes on in the year that that transaction closes. You want to defer it. Now, this program came out in 2018, January 1, 2018. So at that time, hey, it's going to defer it until the end of 2026. That's a pretty good deal. Well, we've been at it for a while here, and now the deferral is kind of the lowest of the potential benefits available. They still haven't, they're considering in Washington, in Congress, but they haven't pulled the trigger yet on a comprehensive bill that would extend the opportunity zone tax deferral beyond 2026. Hasn't happened yet, but the bulk of the players in the industry believe it will happen, and it could extend out by 2 years or possibly even 6. So that would be cool. So what happens after 2026? What happens to that capital gain that you deferred from an unrelated transaction? We got to pay a tax on it. You got to pay a tax on it at the then applicable capital gains rate in 2027 in April when you pay your taxes. not the rate of the date of the generation of that capital gain. Again, there was a lot of arm wrestling there. People objected to the IRS, and said they did not fix that in the regulations. Apparently, they don't want to. So the character of the capital gain that you defer is going to be reported as either short-term or long-term based on what that character of that gain was at the time you actually incurred that gain. So that does date back, the character of it, but the tax rate doesn't. Okay, so that's the deferral portion. The second is once you pay the tax in 2027, you're now invested in that thing for a couple, 3 years into a holding period. If you continue to hold that investment, qualifying opportunity zone investment, for a total of a 10-year hold, and beyond your original investment that you ultimately pay tax on in 2026, after 2026, there's additional appreciation. We call that additional gain, or just additional appreciation of the investment. Then that additional gain after a 10-year hold in exiting the investment will be 100% tax-free, not deferred, but tax-free. Now, when you paid your tax on the original amount invested in 2027, you got a basis step up because you paid the tax on the investment. Because you defer it in when you originally do your opportunity zone investment, you have zero basis in that investment, just like a 1031 is going to get a carryover basis. If you defer the tax on a capital gain that you invest, you have no basis in it. So you build that base to what it was that you originally invested in 2027 when you pay that tax, and then the additional appreciation after a 10-year hold, that's excluded. And so your basis is not taxable, nor is the excluded gain, so it's a tax-free exit. It's phenomenal if you think about it. But equally as important and very significant for particularly real estate investments is the concept of depreciation recapture. In a lot of deals, as we know, if we've been in real estate deals that we've exited, we say, wow, we got this large capital gain. It's going to be great until we realize that 55% of it has to be recaptured as ordinary income because of accelerated depreciation or bonus depreciation. Well, in the exit of an opportunity zone deal, that excluded gain will not be recaptured either as recapture income. So no recapture, all that gain excluded. These are the sort of the tripod of the holy grail of the opportunity zone tax benefit. I'll mention really, really quickly that early on in the program, there was actually a temporary basis step up for your original gain that you invested, as much as 15% of that gain. If you had a 7-year hold or a 5-year hold, it was a 10% step up in your basis, sort of a discount on that tax you owe in 2027. But that's no longer possible because you needed to have at least a 5-year hold. And so that benefit kind of has gone away.
So Patrick,
may come back, but
yeah, one quick question for you here. So the temporary gain deferral, because as I understand it, then if it gets deferred to 2026, and sure, it might get extended beyond that. We'll see what the government does. But people always believe that taxes will increase, and capital gains has always been a item of conversation on if that capital gains tax rate gets increased as well. So if that gets pushed down to 2026 or even further out, are people potentially taking a risk on paying a future capital gains higher tax rate than today? And is the way that we could tell people about that is, well, the value of a dollar today is worth more than a value of a dollar tomorrow. So even if the tax rate increases, let's say 5% in the next couple of years, well, inflation is much higher than that 5%. So in theory, it still makes sense to defer the tax. Is that how you would kind of view that?
Yeah, I mean, yes, you've got to make that judgment call. I mean, but to be honest, as we get closer and closer to 2026, there are a number of investors that are saying, look, I'm comfortable with where capital gains rates are now, and I'm not taking the chance that in April 2027, it's not going to be 44%. Mm-hmm. So I want to pay the taxes now, but can I pay the taxes now and just invest in a deal that's not investing gain from a prior transaction and not rolling it over, just making the investment, and I just want to get the gain exclusion on the additional appreciation? Can I do that? That would be, and that's been asked by a number of investors because it makes sense in that scenario of fearing an increase in capital gains rates. The answer is, unfortunately, no, not entirely. In order to trigger any of these tax benefits, there has to be an atom splitting eligible investment. And that eligible investment, I don't know if you can see my cursor, is this number one. There's got to be at least some level of investable gain in the deal to trigger an eligible gain that will be an opportunity zone investment. Now, you can say, well, okay, I have $100,000 of gain. I really want to pay gain on or tax on some of it, but on as much as I can, because I don't trust the rates in 2027. Well, we've counseled folks where, well, let's do this. Let's only defer 10% of it. So you may and invest that 10% as the eligible gain in an opportunity zone investment. And take the rest of your money, your gain, pay taxes on it, and then use it either to invest in the same deal in a structure that would allow for opportunity zone investments. They say, well, I don't want to do that. I really want the tax incentives associated with that exclusion at the end of 10 years. So there actually is a way, it's quite at the 900 level, where you can lend money, an investor can lend money into his investment. So he's got the original eligible gain equity investment, which has to be equity, as we'll see in a minute. And then a loan, which sort of leverages that. And on the exit, that the additional appreciation gets leveraged as well by that loan and that equity, and you get a bigger excluded gain. So I probably lost a lot of folks there, but remember that
you lost me. No, I'm just kidding.
Yeah,
that's a very complicated structure, but this is why
the important part. My bad. I skipped way ahead.
Oh no, absolutely not, man. This is why you're the OZ guy, right?
The important part is you have to have some level of original eligible gain from an unrelated transaction to trigger any of these tax benefits. If you want to get wiggy with it after that, call us and we're happy to do it.
Yeah, this is extremely interesting, and I'm sure you're going to cover it because, I mean, as you guys know, we had a recent deal that was allowing for QOF to come in, but then also people to invest without capital gains. I'm sure you're going to cover that on like what is and is not qualifying for an opportunity zone investment, right?
Yes, we're going to cover that in just a few minutes here when I flip it over to Stephen to explain that structure. Perfect. And how we came up with it. Okay. All right. So, and I'm gonna race ahead a little bit because we went over some of this stuff. This is a chart that shows how does the eligible investment happen, and we went through this. Gain from an unrelated transaction. That gain has to be invested in a QOF QOF. QOF QOF, nothing else. Can't be a QOZB directly. It's got to be invested in a QOF. That QOF could be your own personal PAN private QOF, as long as it is either a corporation or a partnership, tax partnership, which by definition has to have more than one member. A one-member LLC is disregarded. It's not a tax partnership. So if you have a personal QOF, it's going to have two members in it, or your real estate development syndication sponsor may sponsor a QOF where you can come into it and they'll take care of all of the compliance that has to occur within a QOF. But the point here is you got to go through a QOF. And then the QOF invests in qualified opportunity zone property, which could be tangible property, real estate or personal property located in an opportunity zone that isn't excluded property, or it can be stock, or again, partnership or LLC interest, multi-member LLC, and what is called a UOZB or a QUISB. As practice has developed in this area for reasons that we'll touch on in a minute, it is by far and away, I can't imagine any circumstances where it is not more advantageous if you're doing any sort of a business or real estate development. And by the way, all opportunities and investments have to be what's called trades or businesses or developments. They cannot just be investing in raw land. Because again, remember the purpose in the 2017 Tax Act is build stuff, develop stuff, put people to work, raise all the boats economically in this census tract. Sitting on a piece of land for investment and speculation is not a trade or business. So that's kind of this sort of, remember these three steps, and that's how the basic structure occurs in these deals. Eligible taxpayer who recognizes capital gain from a transaction with an unrelated person. What does related mean? 20% or more common ownership. So related party is really important on the eligible gain. It's also important on in a couple of other ways that we'll see. Okay, we kind of dealt with this. Again, eligible OZ investments must be made through QOFs, QOFs. Okay, QOFs will how are you a QOF or a QOF, and does the IRS have to bless it? Do you have to ask for permission? Do you have to file and get something like a QOF number appointed by the IRS? No, you don't have to do that. But what you do have to do is you have to make an election as a QOF on a Form 8996 that you file with your tax return in the year that you want to start behaving as a QOF, accepting an opportunity zone investment, and then making investments into QOZBs. That's the year that you want to start. And so your tax preparer will file the Form 8996, and that is a self-certification with the IRS. Big mistake that was made by the industry. A lot of folks filed their 8996 for their QOZBs. Don't do that. That will, your investment will not be compliant because it's got to come through the QOF, and then the QOF invests into the QOZB. And so the QOZB is not a QOF, and a QOF can't invest in a QOF. It can only invest in QOZBs or opportunity zone property. So that mistake, which again, early on in this, and there were accounting firms making the mistake, because it's complex and it's not intuitive. So, but don't do that. Real quick, QOFs are constantly going to be measured by what they call the asset test. In a QOF, 90% of its assets measured on an ongoing basis every 6 months during the holding period of an investment in the QOF has to be deployed into what's called qualified opportunity zone property, which again is either tangible property, we don't encourage that, or QOZB interests, either stock or partnership interests, LLC interests in a QOZB. So as long as you're tracking on over 90% of your assets measured there's two ways to measure that. That's kind of getting into the weeds, but essentially what you paid for it, or if you happen to have traded values or whatever, publicly traded companies, which you probably won't, you could use that as a measure as well. Okay. To get into a QOF, it has to be an equity investment. It could be common or preferred stock. It could be an LLC interest that has prefs and waterfalls and all kinds of things, but it's got to be an equity investment. It cannot be debt. That's not a qualified investment. It cannot be convertible debt. It's got to be equity. Now, there are ways to use debt, as I kind of lost you a slide or two ago on leveraging up your eligible investment, which is equity with the loan. And that is a strategy, but the loan part of it is not a qualifying investment. It just leverages up the interest in the QOZB, as we'll see in a minute. Interestingly enough, if you have an investment in a QOF and the QOF invests in a QOZB, it is certainly permissible for an investor to say, well, I wanted to leverage that. I really didn't have the money from my prior transaction to invest. I kind of spent it on a boat, which was not a trader business. Can't even deduct it for business expense in my trader business. So I'll go to my banker, and my banker will lend me money in the amount of the gain that I incurred to make the investment, and I have to pledge my QOF or QOZB interest. Is that okay? Yes, that's okay. Unlike a 1031 transaction, you do not have to quarantine the amount of the gain that you're seeking to defer and create an eligible investment. In a 1031 exchange, all sale proceeds have to be quarantined, whether they're basis or gain. You can't use them until you deploy them into another qualifying investment under the complicated 1031 rules. Not true in an OZ investment. You got a period of time, essentially 180 days, we'll cover in a minute, from the time you realize that gain to make an investment in a QOF. Sometimes that can be longer if your capital gain comes through a K1. Then you actually have until the following tax year, like September 15th, 180 days from March 15th, which is the filing due date of your LLC, which you got your K1 or partnership from. So partnerships and LLCs are really good, and they make really good fodder for OZ investments. Again, I know I'm in the weeds here. Just throw up your hands, guys, when it's like too much. No mas. Roberto Duran it if you have to. Okay. We covered a lot of this already in my ramblings. Okay. We covered this as well. 90% of QOF assets must be invested in qualified opportunity zone property, which is either property acquired after December 31, 2017, or QOZB interests. if you don't have, if you don't meet that test, what happens? I mean, it's not like the world goes away and you have to pay the deferred tax, but the QOF will pay substantial understatement penalties, and those are expensive. So you want to really, your tax preparer who's responsible for looking after the QOF or the QOF really wants to pay attention to this asset test measured in at June 30th and December 31 of every year.
Hey, Patrick, real fast on that, because I know you said there was a few exemptions on that, and so I'll just bring it up here. If, let's take, for instance, there's a property that does not have its certificate or CO, a certificate of occupancy yet, and you buy the property in this year before it has the CO, that would then have a different recognition, right, from a opportunity zone perspective, because it's not in the final status of that real estate? Or
yeah,
how could you get that potential exemption, that 90%?
Yeah, we're gonna move right into that here.
Cool.
This slide just shows what we've already said, that qualified opportunity zone property is comprised of QOZB interests, either stock or partnership LLC, or it's directly into tangible or real estate or equipment. Those are the three levels. Again, we want to hold all of our property in QOZBs for reasons that we're going to get to right away that deal with your question. So we're going to kind of go, well, direct investments are into QOZ business property, not preferred structure, not the recommended structure. Indirect investments in a property through a QOZB, that is the preferred and recommended structure. And here's why. We're not going to skip over direct investments because they're not preferred. Indirect is through a QOF investing in a QOZB. What's a QOZB? Well, it's got a bunch of tests too. It's got to have 70%. It's called its asset test. 70% of its tangible property, owned or leased, has to be qualified opportunity zone business property. The property we said don't invest directly in, invest through the QOZB. The QOZB has to have 70% of its property owned or leased as QOZ business property. Equipment, real estate, yada, yada. If you're in a real estate development, that's a good project because it's going to be located in your OZ and both your real and personal property are going to be there. There's also a couple of other tests. I'll just mention them here. In a QOZB, 50% of the total income of the QOZB going forward at all times to the holding period has to be generated in the active conduct of a trade or business in an opportunity zone. There was a lot of confusion about this, especially because a QOZB doesn't have to be a real estate development. It could be a software company, okay? And it could have contractors in India. And how do you do this? And how do you measure it? And where does your income come from? I sell subscriptions all over the world. Well, they passed a ton of regulations and it dealt with this at great length. They essentially measure your income earned within an OZ, and it could be any OZ or a series of OZs, as relating to where your payroll and your 1099 to your key contractors, where that work is performed, either in terms of number of hours or dollars of payroll. In intellectual property, you have to use that in your trade or business as a QOZB, at least 50% of it. And then QOZBs, again, remember the policy, not investment companies, trades or businesses that make stuff, build stuff, and generate jobs. So there's a rule here, say that you cannot have more than 5% of your property on an ongoing basis if you're a QOZB in what's called non-qualified financial property. Cash equivalent, stocks, bonds, investments, variable annuities, whatever, investments, debt instruments with a maturity of over 18 months. That's all going to say, it's bad. Really important in your private investing in OZ investments. QOZBs cannot have subsidiary investments because that will be deemed non-qualified financial property if it is a true subsidiary that is not a wholly owned LLC subsidiary. QOZBs can have wholly owned OZ subsidiaries. And Dan, I know you're familiar with this because we structured some of this in your deals, but they cannot own 50% of another property. So that would be a subsidiary, and that whole value of that 50% interest in that property would be non-qualified financial property. Send the whole OZ business out of compliance and make that asset holding for your QOF an invalid and a bad asset holding, thereby subjecting your QOF to penalties. So it kind of cascades up as you get bad assets. So remember, your QOZBs can have 100% owned subsidiaries, but not less than 100% owned subsidiaries. So the whole well, certain businesses, I'll just mention this and you can see them here, are excluded. And again, for the reasons that mentioned, you can have develop this census tract, but don't do it as a golf club, racetrack, country club, or massage parlor. So anyway, that comes from the new market tax credit regime, and they just carried it over. Okay. The non-qualified financial asset, 5%. Well, that's kind of hard when you got a real estate development. You raise a bunch of money, it's sitting there in cash or cash equivalents for 24, 40, 36 months. Certainly 24 months while you're doing your real estate development. How can we do that in an OZB? Well, the IRS recognized that, and when they wrote their regulations, they created what's called a working capital safe harbor. And they said, if you follow this working capital, your working capital will not be qualified as non-qualified financial property. It will not be considered non-qualified financial property. It's okay. Further, they went on to say, we're not even going to apply the asset test if you're in a working capital safe harbor period. So the working capital safe harbor period can be up to 31, ideal for an opportunity zone real estate development. But it essentially says you got to have a plan that's in writing, that's going to show your money's coming in from what sources and how you're going to deploy it. And then you've got to sort of maintain that and update it if you need to. And then the way you apply it has to generally be consistent with your written plan as you modify it. And again, you don't have to turn that into the IRS every year, but audited, they're going to look at this. And so one of the things in these projects is we provide with the QOs really need to follow this. They're the ones invested in by the QOF to maintain and have adequate records to substantiate their working capital safe harbor plan. And we actually have a plan that they adopt. Really important. So interestingly enough, in a complicated development or business, this applies to operating businesses as well, if there are sequential tranches of capital, you can have a working capital safe harbor for every tranche that'll go 31 months. As long as that capital that comes in is expended pursuant to the plan at 31 months, up to a total of all aggregate tranches of 61 months deployment. Excuse me. So that's pretty strong. So in this materials, and I won't go over that, this is an example of what an opportunity zone investment can look like. Eligible gain coming from a sale of Facebook stock, invested into, I believe they invested it into an Anthem real estate deal. So I'm gonna, and they did really well, but I'm gonna leave the readers to look at this example themselves. Real quick, again, opportunity zone tax benefits can be layered in with all the other benefits in the tax code, making software developments, real estate developments, put in solar in there with the investment tax credits. I mean, it can be, if you're guys like Stephen and I, we're kids in a candy store structuring these deals, giving you guys tax benefits. In the materials, you'll see a chart. The difference is between a 1031 deferral versus an opportunity zone deferral. Again, most significantly, 1031 gains can only be from investment or business real estate into investment or business real estate. Opportunity zone, a gain from anything. Sell the Mona Lisa, sell Bitcoin, I don't care. And your investment can just be, as long as it's invested in opportunity zone property or business, you're good to go through a QOF, never directly. Okay, here's some materials. I'm going to supplement this, Dan, with Stephen and I were talking with you earlier about some more resources, but here's some. I'm going to include in here one of our dear colleagues and that we collaborate with, and is Ashley Tyson, who's the founder of ozpros.com. Ashley calls himself, deservingly so, the OZ Sherpa, and I actually participate in what he calls his OZ Ascent, where we all collaborate to figure out, where should we go in best practices. But I'm sharing this with you with Ashley's permission about in the materials of a little cheat sheet on OZ investment. It's all wrapped into this, if you will. But thanks to Ashley Tyson for that, and he will be in our resource sheet as well. Stephen, maybe you could. I'm going to hand it to you because you were really the author with our collaborative effort of trying to design what would be kind of the flexible optimum deal for an opportunity zone capital stack and this happened to have been a real estate project.
Yeah, no, I appreciate it. And Dan, I'm sure you're probably sick of me and Patrick talking each other up every time we're on a call, but seriously, that was amazing. I know people pay thousands of dollars to get that kind of information. So That was just really, really great. And every time I listen to it, I think this is probably the third or fourth time I've heard this, but I just get something new out of it every time. So thank you so much, man. So the deal here is that, as Patrick mentioned, there was a couple considerations. Right, first, QOFs can't invest in other QOFs, right? Which means that if you have your own QOF, or you have maybe a pref equity partner or some big JV partner who wants to come in with QOF capital, they cannot you cannot set up your own QOF and just have them come into the QOF. I bring that up because I've been around this industry. I've been around some big players, big security attorney players in this industry, and they all structure the deals pretty much the same. Even QOZBs or OZ properties, they all structure them the same, where they just have one QOF that puts all the capital into the QOZB, and then the QOZB goes into the project, and that works if you have the correct allocation structure in the QOF. But again, that's also very precise language that you need in order to make sure that allocations go to the right people for the tax benefits. That's another topic that we'll talk offline with Dan about. But when you have these other big pref equity partners, or these JV partners come in with their own QOF, they have to have their own sort of they have to be able to purchase something in the QOZB in order to come into the QOZB, in order to have their QOF invest in eligible QOZB, qualified opportunity zone property. So what we did, because I know we're talking about giving that opportunity not only to investors that they were currently talking to, but also potential investors like yourself who might want to set up your own QOF for these purposes. I can imagine a situation where maybe you're a house flipper, and you get you have income coming in every 3 to 6 months, where you want to basically keep investing that gain to get to get the tax deferrals, to get the tax benefits. So you can set up your own QOF on your own, so that you can access these opportunities. But then you couldn't come into a QOF if we structured it with just the QOF, right? With just one deal. So with that said, with that consideration in mind, we structured two entities, two syndication entities, if you will, that offered shares to invest in or to purchase, right? The QOZB sold Class A and Class B shares, and then the QOF only sold Class A shares, right? And the Class A shares all went into the QOZB, and then within the QOZB, we had Class A and Class B shares, which is where the waterfall happened. The waterfall, the distribution rights came at the QOZB level, and then got passed down to the Class A shares, which the QOF was a part of, right? So they shared in a participation of the Class A shares. Now, what this is typically called, a lot of people structure these and call them feeder funds. So this QOF and these other QOFs are essentially feeder funds into the QOZB. Now, a little off topic, feeder funds have a lot of investment advisor issues that come up with them. So the benefit of Dan and his team being the manager of both the sponsored QOF and the QOZB is that we didn't run into that issue because they controlled the asset. Won't go into that any further, but if that issue came up, just know that is also why we did consider that issue when structuring these essential QOF feeder funds, if you will. So the other reason that we did that is, again, let's say that we didn't have any other QOFs coming in, right? We just wanted to structure it with one QOF to go into the property. The problem is that now, if that, especially in a development deal, you need 90% of those assets within the QOF to be completely to be invested in OZ property. And the problem is that the QOF doesn't have the 180 day safe harbor. And Patrick, correct me, stop me anytime I'm saying something wrong here.
No, you're right. You're exactly right. The QOF does have a ticking time bomb, but once it receives capital, it has 180 days to deploy that capital into qualified opportunity zone business property, which we don't recommend, or businesses QOZBs. So there's no safe harbor to extend that. The safe harbor only extends to the QOZB holding of opportunity zone property.
Right. So it was better for us to have these sort of two structures, so that there were less assets in the QOF to need to be deployed. And then in the QOZB, we could just deploy those assets, and within the QOZB, we have that safe harbor, the working capital safe harbor that we can rely on. So it didn't all need to go into the project at once. The other consideration here was the tax allocations. And again, we could structure it. I mean, you have to have very specific allocation language within your operating agreement to accomplish this. And it's actually something that Patrick and I are working through right now. But you know, if you just have one QOF that takes all the investments, you have to have specific allocation language. And for most of your sort of, you know, and I'm just gonna say this, if you're taking an operating agreement for maybe your past deal that wasn't a QOF and just slapping on the term QOF, you might be missing some of those that allocation language within that operating agreement, right? It has to be very specific. So in order to sort of make it easier for the tax preparer within this project to sort of allocate OZ tax benefits and the rest of the regular you know, tax allocations, we created these two separate entities in order to ensure that allocations go to the right people for the tax gain. So that was the other consideration in this. And so now you have this this beautiful structure here that Patrick and I put together with the QOZB, a QOF, and you know, if you're an investor in this deal, you can choose. If you say, hey, I've got capital gain that I want to put into the QOF, great, you have that opportunity. But if you're also like, hey, I have this other income that I don't need that isn't eligible for the tax benefits, you can also purchase QOZB, or you can purchase Class A shares directly, right? So you can either purchase Class A shares directly, or you could purchase you know, interest in the QOF, which would then own Class A shares. So I think that covers it. But Patrick, if I missed anything, just feel free to.
That was great, Stephen. And I want to jump back and answer Dan's question that I just occurred to me I didn't answer. It had to do with the certificate of occupancy. And one of the requirements that's really, really important, and I apologize for skipping over it too quickly, was that the QOZB has to have 70% of its assets at all time in qualified opportunity zone business property, tangible real business property. And that is defined as qualified opportunity zone business property is property that is acquired by purchase or lease after January 1, 2018, and first placed in service in an opportunity zone. So obviously before the effective date, January 21, 2018, there were no opportunity zones. So if you have a project with existing tangible property, equipment, or real estate, then the rules say, well, it can't be first placed into service because it already was. It was there. The developer wants to rehab it, but it's still there. So the regs say that either you get new property or new construction, the structures will always be first placed in service if it's done after 2018 in an opportunity zone. Or if you acquire, let's say, a piece of real estate with structure on it, and that structure predated 2018, then you have to do what's called substantially improve that property. And that's defined in the regs as doubling the adjusted basis of what you paid for that property, exclude out the land itself, but on the structure, do a cost seg into the structure, and you have to invest an amount equal to the allocated amount of the basis in that initial cost seg in order to do a substantial improvement of that property. You have then substantially improved it, and that has to occur within 30 months of when you start the improvements. So that's where you need your working capital. There's a 31-month working capital that can go to 62, but every substantial improvement, every property, you have different structures, they all need to be substantially improved if they were sitting there prior. There's a lot of complicated rules. Well, what happens if you got contiguous properties? Can you sort of aggregate the bases and what you're improving? Yes, maybe sometimes, talk to us, but that's that substantial improvement. So with respect to answer your question, Dan, prior to certificate of occupancy for new construction, that is not considered property that has been placed in service in an opportunity zone. So it's new construction and no substantial improvement required. Okay. Another thing, if you acquired even a structure with real estate with a structure that was vacant for 3 years prior to acquiring it, and you can prove that in an audit, then that property does not need to be substantially improved because it was vacant. Make sure you can prove that with representations and warranties in your PSA, purchase and sale agreement, for that property as to the vacant nature of it. But substantial improvement is a big feature, which is largely why they did the working capital safe harbor. Whoa. So I don't know if we have any more time.
Yeah, we got a few more minutes, and I've got a few more questions that kind of popped to mind there. Because as you guys know, I like doing some land entitlement type opportunities, and those land entitlement deals don't necessarily have to be within that 90% range. And so let's say I've got 90% allocated to true opportunity zones. I can still keep that 10% allocated for these smaller land entitlement type deals that then once I get the permits in place, I can sell those off and start all over again with that same 10%, getting more land entitlement deals, right? And there's no violation of the opportunity zone.
Yeah, I mean, you could absolutely do that. Keep it within your bad asset group. Again, if you did that within a QOZB, you have 30% bad asset store,
Yep.
right? So, but the thing you want, it is also possible to create a trader business. If all of those flips and entitlements are going to be in an opportunity zone, or 70% of them were, right? And you're pretty sure that you can make that test and prove that test in an audit, then dump them all into a QOZB as long as 70% of the value of them on an ongoing basis is work that's being done in entitling those properties. You may have a QOZB of doing that what I call pre-development work.
Yep.
Now, as you sell out of that, right, you're going to have a 10-year hold problem with that property, right? So when you sell assets in a qualified opportunity zone investment prior to the 10-year hold, whether it's a QOF investment or property in a QOZB, if it's not in a 10-year hold, then that's going to be taxable, and it's going to flow up from the QOZB to the QOF to the QOF investor. And you got to be careful of that. There are rules that would allow within the QOZB and the QOF to not deploy it all the way back up to the QOZ and QOF investor, but to reinvest into other opportunity zone business property or QOZBs and still have that 10-year period running. You can recycle it within the QOZB or the QOF within 12 months. So there's that. But remember, any income earned on by a business or on a real estate project, income, rents earned during the holding period, that is not tax-free. The OZ rules only apply to gain, exit gain exclusion. Income earned and distributed during the holding period is taxable. Capital gains, if you don't hold a piece of property and there's a intermittent capital gain we just discussed, sale of a condo unit, sale of an entitled property, that's going to be capital gain unless it's reinvested by the QOZB or QOF within a 12-month period.
Understood. And so I know we've definitely probably gone over an hour, and I want to be respectful of your guys' time. I think I have one more question here, as this has been really, really helpful, guys. When we think about opportunity zones, you showed us that map at the beginning. And the real question is, like, are opportunity zones going to be around in the future? Are more opportunity zones going to be identified in the United States? Like, is there a way that, say you have a property that is in an opportunity zone and then another property nearby that technically is cut off and not in an opportunity zone, is there any way you can apply to get that as part of the opportunity zone? So these are just some questions I have.
Yeah. Answer, not yet. Big question that a lot of people are asking. It's like, well, if we're trying to accomplish this policy, why would you I'm like one lot over. Come on, man.
Yep.
It's like the come on, man defense, right? But there are rules. Like, for example, two parcels of real estate that are geographically contiguous, meaning they border each other, even if separated by a river or a road. Okay, one's in an OZ and the other one isn't. If more than 50% of the combined properties is the property within the OZ, then you can effectively annex that contiguous non-OZ property as OZ property. And believe me, people are playing some incredible structuring games with that as well. But it's something that's pretty easy to show a flaw in on audit. So you don't want to get aggressive on that, but you can do that. The substantial improvement. You can actually aggregate properties that are used in the same trade or business on the same OZ parcel of real estate. You can aggregate the substantial improvement so at 3/4 of it occurs in one building, and another 3 buildings you didn't have to do it in. So as long as you have a big building that you're going to do like 3 times rebuild, but you're not going to touch the other ones, you're still okay on substantial improvement as long as they're all used in the same sort of maybe hospital or mixed use project, same trade or business, common ownership. And the aggregate of it is a doubling of the basis of the structures that existed there.
Certainly. Okay. And so, yeah, I know we ran way over. So this has been extremely helpful. I know when others get to watch it, they will find it just as helpful. So how can people best get in contact with you guys?
Yeah. So when we published this, I didn't have a chance to get Steven's bio in. Sorry, Steven, but I know the kids were keeping you up last night. So we'll have
No
our
problem.
bio pages here. You can get a hold of us here. Get a hold of us through Anthem team, Capital team. We're happy to answer questions. I mean, this is the kind of stuff that, you know, we'll sit around in the evening at a campfire with a beverage and talk about this stuff. So feel free to join in. It's not a imposition for us to talk strategy with any investors or anybody looking to put in a deal together for that matter.
Yeah.
And I just want to mention this on your last question. There is in the new amendments, which have largely been approved by, there's no opposition, Republicans or Democrats, to the new amendments. They don't have the time to put it on the floor because it's going to be a political ping pong for other reasons, because it's agreed upon. There is a provision for governors sunsetting no longer qualifying census tracts and nominating another one to come in and take its place on a state-by-state basis. There would be a procedure like that if they pass this new sort of comprehensive update of the OZ rules and regs, but that's yet to come. We'll let you know when that happens.
I'll be sitting here waiting patiently. So this is great. But yeah, no, certainly, guys. I really, really do appreciate it. I know our audience really appreciates this as well. I want them to be able to get in contact with you guys. Stephen, we'll get your information out there too. And ultimately, since if you guys are watching this, you're watching it probably on an Anthem channel. You can just message us back on whatever platform you're watching us on, and we'll be able to let you know where to find Stephen and Patrick. So, guys, any last thoughts before we cut this?
No, I think Patrick did an amazing job. I appreciate it, man. And Dan, thank you for having us, man.
And I just want to recognize Anthem for being kind of a leader. I would say a leader in the space, not only from the standpoint of trying to deliver additional, return, after-tax return to your investors, but also fulfilling the policy of the whole, the whole act, the whole regime of opportunity zones, redeveloping areas that deserve to be redeveloped that historically have been underserviced and underdeveloped economically. You're doing that. I've seen the projects you're doing it. And the other thing that I would say that puts you in the upper level class is you're doing it in areas that don't need the tax benefits to be a good deal. They are good deals in their own right. So I congratulate you on that.
Yeah, I'll also say too, not to talk Dan up, I really appreciate, because every time he approached us, he's like, hey, how can we make this better for our investors? How can we give these kind of benefits to these investors? And we're always thinking creatively to provide that to investors. And so it's really pushed Patrick and I to think through some alternative deal structures that, believe it or not, Dan, we are actually talking offline. We're developing things right now to potentially present to you in the very near future to accommodate those goals for your investors. So we're really excited about continuing to work together and continue to roll out these different deal structures and different opportunities.
You guys are too awesome. You guys know that. So it's always fun having a conversation with you guys about this stuff. My mind has been blown every single time I have a conversation with you guys, and it just then unlocks more ideas of how we can continue to unlock more value for investors. So thank you guys. I really do appreciate it.
Hey, cool, man. Appreciate it. Thank you so much.
Have a good one.
We'll talk soon.
See you guys.
Bye.